Quick test, do not overthink it. A share is just one tiny ownership claim on a company. So which share is cheaper, this one at $10 or this one at $100? Most beginners pick the $10 stock. That answer feels obvious, smaller price tag, cheaper stock. But in about 30 seconds, I'm going to make the $10 stock the expensive one. Then I'm going to make a PE of 5 turn into a PE of 20 without the stock price moving. And near the end, I am going to show 4 companies with the exact same PE that are not the same investment at all. That is why stock price alone is a trap. It tells you what one tiny ownership square costs. It does not tell you what earnings flow into that square. Price tells you what you pay. Earnings tell you what you are paying for. Now reveal the missing information. The $10 share earns 10 cents per share. The $100 share earns $10 per share. Now, the question changes. You are not comparing price tags anymore. You are comparing price tags to earnings. For the $10 share, you pay $10 for 10 cents of earnings. For the $100 share, you pay $100 for $10 of earnings. Which one is cheaper now? The answer is where you pay less for each dollar of earnings. That is why PE exists. It turns what is the price into a better question. How much am I paying for $1 of earnings? Before the formula becomes a formula, make it physical. A company takes money in. That is revenue. Money goes out to pay workers, rent, factories, software, shipping, interest, taxes, and everything else. Those are expenses. What is left is earnings. Spread those earnings across the ownership squares, and each share gets its small claim on the total. Then the market puts a price tag on the stock. PE compares that price tag to those earnings, P over E, price divided by earnings. For a stock, we usually use the per share version. PE equals share price divided by earnings per share. Just make sure the units match. Use company value with company earnings, or use share price with earnings per share. Do not mix the two. A PE of 10 can sound like a 10-year payback, but it is not guaranteed. Now your turn. 2 companies, same share price. Lemon Stand Co. is $100. Widget Co. is also $100, but Lemon Stand earns $10 per share. Widget Co. earns $2 per share. So what is Lemon Stand's PE? 100 divided by 10. 10. What is Widget Co.'s PE? 100 divided by 2. 50. Same share price, very different valuation. This does not prove Lemon Stand is good. It does not prove Widget Co. is bad. It proves that the market is asking you to pay much more for Widget Co.'s current earnings. Sometimes a high PE exists because investors expect future earnings to grow. Widget Co. earns $2 per share today. But if Widget Co. could eventually earn $10 per share, that same $100 price would be 10 times those future earnings. The high PE already contains a story. The story says earnings will grow. If the story comes true, the high PE may make sense. If the story disappoints, the stock can fall even while the company is still growing. Now for the part that catches people, Boring Tools Co. trades at $100. It earns $20 per share. What is the PE? 100 divided by 25. That looks cheap, but keep your eyes on the E. The price does not move. The price stays frozen at $100. Now, earnings fall from $20 to $10. What is the PE now? 100 divided by 10. 10. Now, earnings fall again from $10 to $5. What is the PE now? 100 divided by 5, 20. Maybe demand was temporarily high. Maybe margins were unusually strong. Maybe last year was the peak of the cycle. The low number is not the bargain. The durable earnings are the bargain. So before trusting a PE ratio, test the E. Question 1, are the earnings real? That means the company is not relying on one-time gains, accounting noise, or adjustments that make profits look better than the business really is. Question 2, are the earnings repeatable? If this year's profit came from a temporary boom, the PE may be using a number that fades. Question 3, are the earnings rising or falling? A company with growing earnings can grow into a higher PE. A company with falling earnings can make a low PE disappear. Real, repeatable, rising or falling, that is the 3E test. Because PE is not really about the P. The price is visible. That the earnings quality is where the work begins. Now prove why PE opens the door but does not inspect the whole house. 4 companies, same price, $30, same EPS today. $2, same PE today. StableCo has a PE of 15. ShrinkCo has a PE of 15. ImproveCo has a PE of 15. DebtCo has a PE of 15. StableCo may keep earning $2. ShrinkCo may fall from $2 to $1. ImproveCo may rise from $2 to $3. DebtCo may still earn $2 today, but heavy debt gives it less room for mistakes. Why does debt matter? Because interest payments and refinancing risk can pressure future earnings. That is why the same PE can mean stable, shrinking, improving, or fragile. Same PE. Different story, PE gets you into the right room. It does not inspect the whole house. There are 3 things finance websites may show you without fully explaining. First, not every stock has a useful PE. If a company is losing money, earnings are negative. When earnings are negative, PE may be missing, meaningless, or shown as NA. That does not mean the website is broken. It means the company does not have positive earnings for this ratio to measure. In that case, investors may look at revenue, cash burn, margins, or a path to future profitability instead. Second, always ask which EE is being used. Trailing PE uses past earnings. Forward PE uses expected future earnings. Same company, different E, different PE. Third, earnings are useful, but cash matters. Accounting earnings can look like paper profit. Free cash flow is closer to the cash bucket the company can actually use. This is not a full free cash flow lesson. Just remember, cash helps confirm whether reported profit is turning into usable money. Now, fix the 6 beginner mistakes. Mistake 1, the $10 stock is cheaper. Better question, how much earnings does one share represent? Mistake 2, low PE means bargain. Better question, what happens if earnings fall? Mistake 3, high PE means bubble. Better question, what growth is already priced in? Mistake 4, every industry should have the same PE. Better question, am I comparing the same kind of business? A bank, a software company, a retailer, and a cyclical manufacturer may deserve different PE ranges because their growth, margins, risk, and earnings stability are different. Mistake 5, every stock has a useful PE. Better question, does this company even have positive earnings? Mistake 6, PE tells me whether to buy. Better question, what would need to be true for this PE to make sense? Do not ask only, is the number low? Ask, what story is this number telling, and can the earnings support that story? Here is the clean ending. Price alone is the wrong question. PE is the better first question. But the real question is what happens to the E. Is the E positive? Is it real? Is it repeatable? Is it trailing or forward? Is it turning into cash? Is it rising or falling? The rule is not low PE good, high PE bad. The rule is ask what has to happen to the E. This is educational only, not financial advice. A PE ratio does not tell you what to buy, it tells you what question to ask next. A low PE is only cheap if the earnings are real, repeatable, and not about to fall. Price alone tells you almost nothing. Price compared to earnings starts the story. Next, in GoGlides Finance School, PS ratio.